So what do you need to know about inflation? Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon and welcome to the Prudent Money Radio Show. I'm your host, Bob Brooks. Thank you so much for joining me today. You know I do appreciate it. So what do you need to know about inflation? Well, Mark Blyth is an economist and author, and he is here today to talk about his book, Inflation, A Guide for Users and Losers. Mark is the William R. Rhodes 57 Professor of International Economics and the Director of the Rhodes Center for International Economics and Finance at the Watson Institute for International and Public Affairs at Brown University. Mark, it is so great to have you on the program. You know, I got to tell you, the thing that I like the best about the book is that you challenge conventional wisdom. You know, we live in a world where everybody's supposed to think the same, and there's two sides to a story, and it's so very important to look beyond conventional wisdom to really get a good idea of where you stand, and you really do that in this book.
Oh, thank you very much. I'm really glad you appreciated it for that. That's exactly what we were trying to do.
Well, and as you and I were talking here just a few seconds ago, I can't think of a more perfect time for this book with just, I don't know if the word's craziness is best to describe what's going on now, but there's just a lot of things that don't make sense, which is a perfect time for people to be asking questions about and challenging how they believe what they believe about inflation.
I agree. So let's get started. How can we best unpack the book for everyone who's listening?
Well, let's talk a little bit about the subtitle of the book, Users versus Losers. Talk a little bit about what you mean with that.
Right. So you're going to hear people from the Fed and all the other agencies come out, and this is true worldwide. And the one thing they say whenever you have inflation is we all suffer from inflation. And if you think about this for 5 minutes, you know this isn't true. Because what inflation measures is the goods that we consume. So let's think about everything we consume. We consume gasoline, we consume rent when you rent a house, when you go to the grocery store, the price of eggs, the whole thing, right? Now, let's imagine that you're in the bottom 20% or 40% of all incomes in the country. You're not that well off. A 5% inflation, that's a serious thing for you and your family. That dictates whether you're going to put something on the table or not. You're in the top 5% or 10% of the income distribution. You probably go shopping at Whole Foods, which basically means you've been impervious to normal prices for years anyway, because you're paying a third more than you should for your groceries because you like the avocados or whatever. But the point is, at the top end, you spend much less of your overall income on goods that we consume. So you just don't feel inflation the same way. So that's why when people say it's a tax on the poor, it really is. And it's really about people who are earning less than basically the median income or above. That's who really get hit by inflation. And we wanted to make that quite clear. We don't all suffer from this.
Well, give us a real-world example of a group that benefited from inflation within the past several years.
Oh, absolutely. Dead easy. Let's think about oil companies. So what happened in Europe was the Russian gas got cut off, and they are totally dependent on this. So you've got to find some gas. So where do you find gas? You find gas in places like Qatar, which is one of the biggest exporters in the world. You also find it in the United States, which is actually the world's biggest carbon exporter. People don't realize this. You think it's Saudi Arabia. It's actually us. So what did we do? We went down to Galveston, and we basically got a bunch of gas, and we liquidized it, we put it on boats, and we sent it to Europe. And what does that do? That basically pushes up the price for everybody because there's more demand for it. It means your electricity bill's getting a bit more expensive if you're burning gas to do this. But what it means for those companies is their profits are going through the roof. By one accounting of this, U.S. carbon majors made $220 billion extra profit over their normal profits in 2022. That's a huge amount of money.
Yes.
Someone else who made this one, all your listeners will get this one, right? So the Fed puts up interest rates to 5%. Did your savings account go up to 5%? So basically, the way that banks work is they take the spread between what they borrow it and what they lend it. So if they're now basically going 5% and above on their interest rates, you should get 3 or 4% in the deposit rate. but your deposits stayed almost at zero throughout the whole period. So they just took that spread and pocketed it. This was so bad that in Italy, the government actually taxed the banks as a windfall tax to try and get some of that money back for the depositors because they simply weren't handing it on to the depositors.
You know, Mark, you hear a lot of the word stagflation right now. Word that came from the 70s when we had inflation and declining economic growth at the same time. Is that model still valid, or will we see something potentially different this time around?
I think it's very different. It's like that old line about, can a man ever bathe in the same river twice? No, because it's not the same river and it's not the same man, right? And we don't live in the 70s anymore, right?
Right.
Back in the 70s, think about this, right? 1 in 5 jobs in the US were in the auto sector, right? So this is a very different, much more industrial economy. And when you also had unions back in the day, and that meant when prices went up, unions could basically hold up production. They could go on strike. They could demand higher wages. Well, globalization, outsourcing, all that sort of stuff, that got rid of all that. And what it's meant is that the wage share of national income has gone down, and the profit share has gone up. So corporations have been doing really, really well, but I'm sure your listeners are going, well, where's my big paycheck? Where's my payoff on this one? And we haven't seen that happen, and that's part of going into the mix for this too.
You know, I do want to there's 2 or 3 main questions I want to ask. This is one of them. And just to help me understand about current monetary policy, I mean, I think the Fed chair, Jerome Powell's done a good job with a tough situation at hand. He's being cautious. I think that makes sense. But what would happen if Trump were to get what he really wants, which is a much, much lower federal funds rate? It seems to me that would, ignite inflation. He doesn't seem to think so. What's missing here?
So I think what Trump and the people around Trump are banking on is essentially there's a lot of spare capacity in the economy that we're not really using. And if you go back to 2017, Trump had a kind of Twitter spat with the Fed back then. And I don't know if people remember this. He said, don't you dare raise interest rates. Don't you dare choke off this recovery because I want to run the economy hot. And he kind of won that one because at the same time the Fed were listening to other things that said, yeah, just because wages are going up, it doesn't mean you need to slam on the brakes and raise interest rates. How about you let a little bit of that growth pass through to normal people? And they did. And in 2017 and 2018, the bottom 40% of the income distribution saw their wages grow in a sustained way, and that was the first time in years that had happened. So the people around Trump had learned from that lesson that basically, you know what, we can juice this a bit more than people think. The second reason you want to do this is because of, first of all, bailing out the banks in 2008. That added like 30% of debt to the federal debt pile. And then the COVID spending. We've now got a huge federal debt. And what you want to do is massage the rate that you pay on that debt down. So if the federal funds rate goes down, you don't set what's called the long end of the curve. The market does that. But you can basically finance yourself through more short-term issuance, and you can do that at a much lower interest rate, and that makes the debt much more sustainable. So there's 2 things going on here as to why they want to do this. Now, is this going to work? Well, so far the inflation hasn't showed up much in the tariffs. But ultimately, if you're taking $100 billion a month or whatever the figure is in tariffs, that's got to show up somewhere, right? Eventually, when you put a tariff up on something, you're causing a supply shortage. And when you do that, the price has to go up. So that's going to have to show up somewhere. So it's a contest, if you will, between these 2 views of the economy. We can push it more. We can do a lot more without igniting inflation. And a more standard view that says, actually, you're already at the limit, and if you do this, you're going to get inflation. And we're going to find out in the next couple of months which way this goes.
So where do you stand? What do you think will happen?
I'm kind of sympathetic to the Trump view on this one. I don't think that, like, dropping interest rates, let's say another 1%, would really cause that much of an inflation spike.
No.
Where you're going to get it is in the bond market. Because if you do that, then what happens is bond investors get more nervous because they think there's going to be inflation. They're going to demand more interest on the next issuance of bonds, which means the rates could go higher rather than lower. So any benefit you get from lower interest rates could be offset by basically the bond guys saying you need to pay me more. So it could be all for nothing, right? So that's the risk with this one. But I think that, the argument for a long time has been, the Fed has this 2% target, and we need to stay at 2%. Why do we need to stay at 2%? Well, why is that the holy number? Maybe we could go a little faster than that. So I've always been a bit more sympathetic to that than most. But ultimately, is this inflationary? It could well be. All the textbooks tell us this is the case, but so far it ain't showed up. We'll need to wait and see in the next couple of months.
I mean, is it fair to say we're entering into uncharted waters?
Oh, absolutely. Yeah, let's think about what's different now, right? What we did is we issued this legislation called the Genius Act, which gives the United States basically the lead in issuing so-called stable coins in the crypto market. Now, 96% of stablecoin transactions are used to basically just buy other bits of crypto. It doesn't really have any kind of use value.
Right.
But you can imagine a world in which, imagine that, let's say, Walmart had their own coin. We're going to call it a wall coin. And you swap dollars for wall coins. And what they do is they give you a little bit more than a dollar would give you if you use the wall coin. Now, what's the benefit for them? They don't have to use MasterCard. They don't have to use Visa. They don't have to use banks. Suddenly you're just in this internal system. And then they can give you a little bit more and they make more as well. So you can see why big companies, etc., might want these things to do transactions. But at the same time, these things have to be backed by treasury bills. You don't get to issue the coin unless you buy a treasury bill. So you're kind of keeping a captive market for treasury bills. All right, let's think about that. What you're actually saying is the value of the treasury market is now determined by crypto traders. Oh, hang on a minute. That's what you call uncharted territory.
Oh, yeah, no doubt. So you mentioned treasuries a second ago, the bond market. One of the things that I looked up this morning before we talked is that yesterday and today, the 10-year yield is up about 2.25%. Does that surprise you? Is that concerning? It doesn't seem like it should be that way, but kind of going the opposite of what everybody else thinks is supposed to go.
Well, a lot of countries are in trouble because, the British yields are up, French yields are up. Everybody has the same sort of problems. We're an aging society. We're going to have less people that are able to work to pay taxes. At the same time, our societies have become uncomfortable with immigration, so you're not going to get new people in the door that way. That means your labor market's going to shrink at the same time your number of old people is going to go up. None of that's good for kind of long-term growth and productivity. So if you're holding a 10 or a 20 or a 30-year bond from one of these countries, you might begin to think to yourself, hang on, am I really going to get my money at the end of this? Or are they going to run the printing presses to basically make this work, to square this circle? And I'm going to be holding the bond that's going to be devalued. So not just the U.S., structurally, all the Western economies are kind of in a tough spot with this one. The United States is the global reserve asset, as they say. It's the savings bond for the world. Treasury auctions never fail, despite the fact that people say that who are all these people buying this debt must be crazy. And it's like, well, yeah, because what else are they going to buy? Chinese bonds? Give me a break, right?
Right.
So ultimately, kind of, we're in the sweet spot, but we're all in a tough spot at the same time, if you know what I mean.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thanks so much for joining me today. I do appreciate it. Talking to Mark Blyth about a great book. It's called Inflation, A Guide for Users and Losers. So tell me this, Mark, if you were the Honorable Jay Powell, what would you do differently, or how would you handle the job at hand?
Well, I go back to what you said about Powell. I think he's done a good job in difficult circumstances as well, because it's not clear to me that slashing interest rates to zero is actually what the country needs at this point, right? And
Right.
yes, it would be good to have lower mortgage rates and so on and restart the housing market. But as we said, if that leads to the bond market freaking out, you gain on one side and then you're done on the other. So as your program is called Prudent Money, essentially that's what he did. He's being prudential. He's not taking a gamble. He's not taking a risk. And if you think about the Fed as an organization, whether you have problems with its independence and what it does in policy, etc., its job is to be the one bit of the government that's prudential. That's the gig. So if I was there, I'm not sure I would do that much different from what he's doing as well. Now, we can have Scott Bessent's critique that he put out the other day about how the policies of the past 10 years, quantitative easing, have distorted asset prices and led to greater inequality and all that sort of stuff. And by and large, I would agree with him. And that's a whole set of important issues. But in terms of day-to-day management, you've got to remember these guys have got two tools. raise and lower the interest rate, which is altering the price of money, and buy and sell assets when that doesn't work. We're not in a world where we're doing the buy and sell assets thing, so these guys really have one thing, raise and lower the price of money. It's a bit of a blunt instrument, and when you pull it all the way up, as Paul Volcker showed us in the 1980s, you can do a lot of damage with that. And that's why this time around, they went from 0 to 5, they didn't go from 0 to 20. They were prudential, they were cautious. Now, at the same time, when they went from 0 to 5, is that what really did the trick and kind of got rid of the inflation that was in the system? Or was it just the fact that everyone found Qatar on a map and finally got new gas and the prices normalized? I would say it had more to do with that than interest rates. So I think that we expect too much of them with the tools that they've got. And they also talk themselves into a corner by saying that we've got this. I don't really think they've got it.
I mean, do you see a situation ever occurring where the Fed just kind of loses control of the situation? What worked doesn't work anymore.
That's a hard one. Yeah, it's a hard one because ultimately that would be like what would be a catastrophic policy error for the Fed? And it would either be raise that one tool they've got to the roof and cause an absolutely enormous recession and bankrupt loads of people, or slam it down so low that you get free money. Everyone goes on a borrowing binge and you either generate inflation or a banking crisis. So that would be the two ways that they could really screw up. There's other ways in which the world around them is changing that makes their job much harder. So, for example, go back to tariffs. How does that complicate things? Well, because now another way of stabilizing your expectations of your bond investors is look at all the money these guys are making off of tariffs. That's great. That's going to pay for the tax cuts. All right, so now the bond market is basically stabilized by crypto buyers and the tariffs. If I'm the Fed chair, I'm like, that's not good, because if either of those things go, I'm going to be asked to deal with it. And it's not clear how my one tool is going to deal with that.
So you mentioned mortgage rates. This does not seem like good news for mortgage rates.
It's not. It's absolutely not. It really isn't. But, people have to recall as well, though, that you go back to about 2004, 2003, this is what you paid for a mortgage.
Right, that's true.
Right? And if you go back to the 1990s, you paid higher than this for a mortgage. What happened was after the financial crisis, the Fed found out that you could put interest rates to zero and nobody cares because nobody's borrowing because everyone's freaked out. So they tried that policy of quantitative easing. They basically said to the private sector, give me all your bonds and I'll take loads of cash and give you the cash and hopefully you'll spend it. And it kind of didn't work. Most of it, that's why houses are so expensive, because people went out and bought assets with the money instead. It didn't kickstart the economy. But nonetheless, what we did is we had a decade of almost zero interest rates. And that brought us all the fun stuff like crypto and meme stocks and SPACs and all that stuff, because essentially money's free. Now, money shouldn't be free. There's meant to be a premium for somebody saving and somebody borrowing it, and the bank sits in the middle and takes the spread. If basically money's free, you just take ridiculous risks, and that's kind of what happened. So I think what's happening now is we're going back to where things in a sense should be, that there should be a positive rate of interest. And if there is positive inflation going forward, because we also had a historically ridiculously low inflation, then, 3%, if you're facing 3% inflation, you're going to be looking at 4% interest rates. Now, we're currently higher than that, but not much higher than that.
Right.
So, I think this is we're going back to the future in a sense.
So you mentioned mortgage rates. This does not seem like good news for mortgage rates.
It's not. It's absolutely not. It really isn't. But, people have to recall as well, though, that you go back to about 2004, 2003, this is what you paid for a mortgage.
Right, that's true.
Right? And if you go back to the 1990s, you paid higher than this for a mortgage. What happened was after the financial crisis, the Fed found out that you could put interest rates to zero and nobody cares because nobody's borrowing because everyone's freaked out. So they tried that policy of quantitative easing. They basically said to the private sector, give me all your bonds and I'll take loads of cash and give you the cash and hopefully you'll spend it. And it kind of didn't work. Most of it, that's why houses are so expensive, because people went out and bought assets with the money instead. It didn't kickstart the economy. But nonetheless, what we did is we had a decade of almost zero interest rates. And that brought us all the fun stuff like crypto and meme stocks and SPACs and all that stuff, because essentially money's free. Now, money shouldn't be free. There's meant to be a premium for somebody saving and somebody borrowing it, and the bank sits in the middle and takes the spread. If basically money's free, you just take ridiculous risks, and that's kind of what happened. So I think what's happening now is we're going back to where things, in a sense, should be, that there should be a positive rate of interest. And if there is positive inflation going forward, because we also had a historically ridiculously low inflation, then, 3%, if you're facing 3% inflation, you're going to be looking at 4% interest rates. Now, we're currently higher than that, but not much higher than that.
Right.
So, I think this is we're going back to the future in a sense.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. We're talking to Mark Blyth in a great book called Inflation, A Guide for Users and Losers. Let's talk a little bit. You said in the book you called for a Swiss Army knife solution for inflation. Talk a little bit about what you mean by that.
So this goes back to this idea that, we want the central bank to deal with this, and they go, okay, we've got this. And it turns out they got one tool. They got one blade in the Swiss Army knife. It's a powerful one, interest rates. You push them up to 20, you can blow up the economy. But if you're in a crisis and you cut them to zero and nobody wants to spend, it doesn't do anything. So it's powerful on the way up and weak on the way down. So let's say there's an inflation. What's the problem you're trying to solve? Well, one of them is you want to get the inflation out of the system. So first you have to decide what's causing it. Now, the traditional way we think about this, going back to the 70s, it's always money. And an easy way to think about that was the Biden stimulus, right? All those checks, paycheck protection, huge amount of spending, right? But at the same time, the supply chains are contracting, and that's going to cause inflation. Well, it certainly had something to do with what happened in the U.S., but here's the thing. There are 30 countries around the world that had inflation at the same time. Only one of them had the Biden checks, and not everybody spent loads of money, and yet they all had inflation. Why? Because what actually happened was nothing to do with money, really. It was we make everything in China, and we couldn't get it. Everybody got sent home from the labor market for a long time, and at the same time, energy got really expensive, particularly in Europe. So if you then say, okay, the problem's a supply shock, if you want to solve the problem, basically you find more supply. You go to Qatar, you go to Galveston, you buy the LNG, you normalize the market, you change the supply side. That's what you do. So first of all, what you do is you've got to think it as more than just money. Money absolutely can cause an inflation. Government spending out of control absolutely can cause an inflation. But it doesn't cause every inflation. And it's really not clear that's the one that we had most recently. Second thing is, what are you trying to solve? You're probably trying to solve the harm that happens to people, the ones that get hurt by this. And there's various interesting ways of doing this. Now, price controls are one of those things that are very controversial. People who are old enough may remember that in the 1970s, Nixon brought in price controls. Controlled the price of wages, they controlled the price of pork. During the Carter administration, you could gas up on a Tuesday if you had an odd number on your car or something crazy like this. This was not how America works, and people hated it, right? But the weird thing was, when Nixon did the price controls, and this is something we didn't know, we found this out in doing research for the book, when the price controls were mandatory, they were by law, right? They actually kind of worked. And inflation went from 8% down to about 1.8% over an 18-month period. It was really low. Then what Nixon did was, okay, problem solved. We're going to keep these things as guideposts, and we want everyone to sort of not try and take advantage of the situation and push prices up. Yeah, you can guess what happened. Immediately it became voluntary. Everybody busted through it and inflation reignited. Now, does that prove that price controls don't work? Well, all the way through World War II we had price controls, and it kind of kept a lid on inflation, right? What else could we do? Well, it's good. We had a kind of series of experiments around the world in terms of different countries in this period between 21 and 24. Some of them, a lot of them tried different forms of control. Now, here's one that was interesting and worked. The Spanish government looked at this and said, all right, what's the problem people are facing? If you're a poor Spaniard or a low-income Spaniard, or you've got lots of kids, right, and one of you's been sent home and your job's gone, we've got a problem to solve. We're not going to solve the inflation directly, but what about if we subsidize your electricity if you were below a certain income? What if we give you, free public transport if you live in a city? So what they did was they said, we can't solve the problem, the income hit you're taking directly, but we can give you subsidies in other ways that might compensate. That's a Swiss Army knife approach. That's thinking out of the box, right?
Out of the box.
One of the really bad examples of this happened in Scotland. So Scotland, where I come from, you can probably tell by the accent, right? If you go to Edinburgh, the capital city, I mean, it's a beautiful city and loads of tourists, and it looks like Harry Potterville, the whole thing. And it's filled with Airbnbs because of this, these short-term rentals. But it's also got a big university and stuff like that, so there's lots of people who rent houses. So the government comes along and says, right, nobody gets thrown out. There's nobody getting evicted in this period. You've got to keep people in their tenancies. And also, you put restrictions on basically, the amount they could charge and that sort of stuff. And what happened was, landlords instantly looked at this, because the way they used to do it was you'd rent 9 months to a student, and then in the summer you'd become an Airbnb, and then you get 3 months, and then you go back. The minute the students left, they basically turned everything into a 3-month tenancy because that wasn't covered by the regulation. And what that meant was rents went up by 20 to 30% in a very short period of time because all that housing disappeared from the market. So this is an example of trying to do a price control and it massively backfiring. So our story is basically, first of all, identify what's causing it, and then think about what are the creative solutions you could do that might actually work and make a difference in people's lives. And don't try and put it all on interest rates, because when you run out of gas and you raise the price of money, it's not exactly clear how that's going to help.
Once again, the name of the book is Inflation, A Guide for Users and Losers. Mark, congratulations on your book, and we'll look forward to future projects.
Oh, it's great, and I really enjoyed the conversation. Great questions. You really got to the heart of the matter. I'm really happy that you called. It's great to be on your show.
Thank you, Mark. I appreciate it. This is Bob Brooks. If you had a question for me, please go to the website at prudentmoney.com and send it in, because we are all out of time. Till we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.